Hello to all Inderes TV viewers and listeners. Anora published their Q3 this morning, and they also announced the CEO change some 2 weeks ago. And we have today here the new CEO, Jacek Pastuszka, if I get the name correct, hopefully, and as well as CFO Sigmund Toth for this interview today. So welcome, gentlemen.
Thank you.
So let's start with Jacek. You were appointed as the CEO just a couple of weeks ago, like mentioned. So can you share something around your background and why did you choose to come to Anora?
Yeah, if this was a couple of weeks ago, I would say it's a long time, but it was actually 11 days ago. So 11 days on the job. In terms of my background, probably what is most relevant here is my previous experiences. I was the EVP, the Executive Vice President for Western Europe in the Carlsberg Group. So I was in charge of Western European business of Carlsberg, which is half of Carlsberg's business. And also what I have in my CV, and I enjoyed this period tremendously, was 4 years here in Oslo, where we are sitting right now, actually not far from the place where we are sitting, which is Ringnes, being the Carlsberg operation in Norway. So that's in terms of my background. I have done a few other things in the past, mostly with consumer goods companies. I was with P&G, with Danone, and with Carlsberg for the last 12 years. And also I was for a period of time, for about 4 years, in financial services. I was managing AIG's business, American International Group's business in the Baltics and Poland. What brought me here, I think there are a few factors. I'm 60 years old. I actually broke my retirement to be here, which I think is a funny fact here. I retired early. I cashed in on my compensation plan in Carlsberg in 21 with the intent to retire. Yep. At the age of 58, and I enjoyed my 2.5 years retiring, but I was approached with this opportunity. And what attracted me in this opportunity were probably 3 things. First is the strategy as stated. It was mentioned also in the call earlier today. We are far away, I think, from being able to fully utilize the potential behind this strategy, and we have some groundwork to do first before we can get there. But the strategy as such, I think, is still valid, and we'll find it exciting. Another reason why I thought it may be a good opportunity for me is that the fit between my experiences, hopefully capabilities and talents as well, if there are any, the fit and the match with the situation and the business is good. I feel it's my size, my level of complexity, my level of business challenge. It is, I wouldn't use big words, but it is a minor turnaround operation, and I thrive usually in this type of environment. The outcome of this is obviously uncertain. Nobody can predict the future, but obviously, no, I will give it my best, and I believe the fit is quite good with the experience and the competences. And then the third, who knows, maybe the most important argument, and the one that I have used to convince my wife as well to let me go, is that I have a chance to come back to the Nordics. I'm a big fan. I'm Polish originally, as you know, but I spent quite a lot of time of my life and business career in the Nordic business, being responsible, either directly living in Copenhagen and Oslo for a few years, but also being responsible for the other businesses like Synebrihov in Finland or the Carlsberg business in Sweden. So I'm very fond. I have a bit of affinity, I believe, to this part of the world. I know what its strengths and weaknesses, yes, and I think I can add what is needed to make the company that is very much part of this culture to make it effective. Whether successful, no, we'll see, but definitely more effective than it was so far. That's in terms of motivation.
Yeah, great. That's very, very helpful. Then the second question for you, just where will your focus be on, and or the kind of company's focus from your perspective in the first weeks and months as a CEO?
Actually, defining my focus is very simple. I strongly believe that diagnosis is more important at this stage for me than prescription. Actually, prescription before diagnosis would be malpractice in any profession, but in management profession as well. So I need to avoid this trap. Obviously, I have some early observations, and I'm sharing my conclusions and hypotheses with my management team. But you know how it is, especially at the early stage. Connecting 2 dots is very simple. Connecting 3 dots or 4 dots is still within your reach. So it's easy to have a clear view on things you don't understand, paradoxically, maybe. Yes. So. So I need to give it more time, and the way I will give it time, and I committed it to our organization, is that I will conduct 100 interviews in the first 100 days with the key managers and the key people in the company to understand the business. So my focus is on learning. Ideally, I would prefer to do nothing in this first 100 days, and unfortunately, given where the business situation is, as you have seen in our call, we have to accelerate the execution of some of the things that were already on the table because we just don't have time to wait. But I will use this next 100 days or 3-4 months to prepare well for what's next.
Great, that's very good, and we will come back to those conclusions then later on. But let's now jump now jump more to the business side than with Sigmund. I think so. Starting actually from another announcement you made back in September and also finalized the divestment of your cognac business. So can you explain a bit of the rationale for that from your perspective?
Well, I think that the rationale for that one is quite simple. And you know, if you want to start with the theoretical end of it, you know, there is this concept, you know, in mergers and acquisitions or divestitures, you know, the concept of the right owner for a business. Right, because a business, you know, it is what it is in and of itself, right? So it has a certain set of characteristics, how much money it is making. But then, you know, there might be a bigger system, you know, an acquirer that can create more value if this asset is part of their portfolio rather than the portfolio of someone else. And you know, in the case of cognac, I mean, this is a business that is very, very international, of course, you know, or maybe you don't know, but on a per capita basis, it's actually the Norwegians and the Finns that are the biggest consumers of a cognac in the world. I mean, by far, on a per capita basis. But we are still relatively small countries, and where the growth is happening and where the big business is in the United States and in Asia, right, especially in China. And, you know, as much as we would like to have a distribution network and footprint there, and we do work with distributors, we don't have our own sales force or distribution capabilities in those markets. So when you look simply at, you know, where do you need to be if you want to be successful with cognac, Anora commercially is not there. So that's on the one side. That's on our ability to, let's say, generate the return on the business, right? And then, as you can see from the effect, you know, we talked in the earnings call, and I recommend those who haven't seen it to go and look at the recording. It has a very significant impact on our working capital because cognac business is very asset heavy. You need to, just like in whiskey, or for that matter, aquavit to a lesser extent, this beautiful spirit, it gains its taste, you know, especially when it is aged, you know, over many, many years. The XOs, it's minimum 10 years of aging. So who says 10 years of aging says, you know, a lot of inventory. So there is a carrying cost, you know, of that inventory, and then all of the other costs as well that are related to that business. So the acquisition of the wine, the salary cost of the skilled personnel that you need to operate there. All of those costs. We were, as owners of Larsen, competing for, you know, against the big players, you know, who have a different scale and distribution capabilities, the Hennessy's and the Remis of this world. All right, so that's where this big, and you see that in the expression of the multiples, right? So what we sold it for versus the 2 million euro impact it will have in our EBITDA is that, you know, it is quite clearly worth more to someone than it was worth to us. And the reason for that is that they have capabilities and a high likelihood of making a better return on the same invested capital than we did.
Yeah, that's really very clear, and yeah, you mentioned the quite good multiples from your perspective at least. So do you think you could sell other brands in your portfolio with the similar kind of valuation?
Well, I mean, I think again, although the Larsen brand is a great brand that we have spent significant efforts building, and it has a strong position in the Nordics, the brand value was probably not the largest part of this transaction. It was more, to a large extent, as it is in cognac and whiskey, the value of the assets of the aged eau-de-vie. But of course, just as we always say, and that on this topic, I'm not going to reveal any secrets or things that we are working on, not working on, but we're continuously looking at our portfolio, and that goes, although that's not our focus now for the M&A, because we need to get our house in order first and our financials and our capacity. We are still looking at what's going out on the market, and obviously I think that it's part of our job, as part of the job of capital allocation, to continuously be looking at all parts of our portfolio, again with this logic of, are we the best owner for this asset or this business or not, or could this be a better fit in someone else's business?
Sure, that's clear. Then let's jump to the actual Q3 figures. So can you just summarize what were the highlights and how did the quarter go from your perspective? As you mentioned in the webcast, it was pretty much a continuation of the same trends we have seen. So nothing much new in that respect.
I think that you did then a better job of summarizing than probably I am capable of. But I mean, I think that this terrible expression of less worse, I don't know if that's proper English even, but I think that you get the idea that we are not proud of that performance or happy with it, but it's not decreasing at the same pace or same percentage as the previous quarter, and it's obviously, while we are not happy with the outcome, we do think that we have taken some corrective actions, and those corrective actions to some extent are bearing their fruit. So we have a big challenge with the profitability on our wine segment, but then on the spirits and industrial, the other two, there was some improvement actually year on year in a tough trading environment. So that, I would say, is the summary, is that we're getting closer to some sort of stabilization, but at an unacceptably low level. So we need to do more to get the profitability up.
On a standalone basis, when you have a quarter with a single-digit decline in net revenue, and then as a consequence, a double-digit decline in profitability in EBITDA, cannot be called a good quarter by any standards. It was a poor quarter. Yes. Luckily, maybe we had this extremely low base of Q2. Yes, so we can try to spin some positive story about it. But exactly as Sigmund said, this was not a good quarter for us. At the same time, we understand very clearly where this meltdown is coming from, and this is what I was trying to be very precise about. It is coming from a very one source, which is the partner wine business, mostly in Sweden, if I were to be even more precise. The fact that we are able to identify it so precisely and talk about it so clearly does not mean that there is a quick fix to this one. But what is important here is that we need to work both on the ways to offset it in other parts of the business, and at the same time get to the root of the issue, yes, and try to fix it there, which I also was trying to refer to through this discussion around more actively managing the partner mix, managing it in a way that maximizes or increases the share of partners who are willing to build value together with us. In the current situation, it's hard for us to build value if we are so desperately losing money in this part of the business, and it's affecting the profitability of the total company.
Like you mentioned, it's very much the wine segment which is doing poorly and dragging your earnings, and you mentioned the lost customers there, but there's also the negative impacts of FX and then the poor performance of Globus. So when should we expect those factors to start to improve or kind of be mitigated somehow if we look at the FX and Globus part?
Well, I mean, with FX, the actual FX movement that I cannot give you.
No, sure.
Then I would, if I were good, better at that, I would not be sitting in this call, but in front of my Bloomberg, making millions. But although I have Hungarian origins, I'm not George Soros. So let me then comment on what we do about it. And it's two things. One of them is to institute now more significant hedging. So that will be, starting from the upcoming pricing period, but that's only a palliative, right? That is taking care of having stability roughly for the pricing period at the monopoly. So once that we set our prices, our gross margin, is more predictable than it is today, for better or for worse, right? Because of course, and wouldn't that be unlucky, if the currency then starts strengthening, then of course you don't get the benefit during the hedging period, but that's as it is, you take the upsides with the downsides. And then the other aspect, as Jacek has mentioned, we have a pricing window now, January 1st in Norway, another one March 1st in Sweden. And this is our opportunity together with our partners where relevant or on our own brands to look at what more still needs to be done. So there is some element, let's call it, of volatility which is taken out, but the basic job to be done still remains. And then the other thing is again managing then actively the partner portfolio. In terms of Globus, it is a more there is no quick fix there. I mean, it was a quick cold shower, so that went quite fast when we realized, the underlying profitability was not what we believed it to be. But then, now we are at the stage where from that lower base, together with the management of Globus, we are step by step rebuilding the profitability. And I think that it's fair to say that there's some progress made already, but that there is still more work ahead of us. So I would expect that to be rather a sort of a gradual increase than that immediately it's sort of starting to contribute to profitability levels that we expected when we made the acquisition. I think that's the honest answer to the question.
Yeah, that's clear. And then just to follow up on the FX hedging, can you share what kind of annual cost are you expecting now when you are starting to hedge fully, or at least significantly more than previously?
No, well, I mean, I think that in terms of the hedging cost, I don't have the exact number yet, but I mean, we're talking about a few basis points, right? In terms of the margin of the banks, and then also maybe some zero cost options. So I mean, I'm not sure that this will be the most material thing, the actual cost of the hedging.
Yeah. Okay, that's clear. Then the final question on your guidance. There was also a lot of discussion on this on your webcast, but your midpoint now with your unchanged full year guidance basically requires some 33 million of adjusted EBITDA for Q4, which is quite a lot more than what you did last year, even if we adjust for this inventory write down, which was burdening that. So can you just summarize again what's the key drivers for this improvement that you are expecting?
Well, I mean, I think again, and it bears repeating, right? That the guidance is a range, right? And it goes, from a high point to a low point, right? And I think that it's fair to say, as several people have mentioned, that it will be challenging, and another way of putting that is maybe that it's likely to be in the lower end of the guidance, although these are the big months, right, where a positive impact, from better than expected volumes, can also have a very positive impact on us. But that being said, the big drivers are the full impact of the price increases in September and in October, continued cost control versus last year, this absence of this Globus one-time impact, and more favorable comparables in terms of the cost of goods sold, which although are expected to be stable versus previous quarter, they will be less worse. There is that terrible expression again, than on a year-over-year basis than the year-to-date were, because some of these barley prices, etc., had already made their way, into the cost of goods sold last year in Q4.
Yeah, but it's fair to say that we are aiming at the low end of this guidance.
Yes.
Yeah.
Okay, that's very clear. So thank you guys for the interview, and all the best for the rest of the year.
Thank you very much.
Thank you.
Bye-bye.